This is another recording of a topic that we've included in nuances. As we say every time, learning to trade or get the basics is extremely important. Without that, you have no starting point. But once you have the basics down, then there's, in any profession, nuances usually make the difference. And what we're going to be talking about today, randomness, is clearly one of the nuances that we deal with. And it's a difficult nuance, particularly psychologically. We actually laughed about naming this video, Have You Been Screwed Over by Randomness? Simply because it just really can mess up our mind. But let's take a look at the specific example that we're going to be using for this video. In order to take a look at that example, it is really important to review what happened on the previous session. The previous session is February 11th. And if you'll look at the 11th, which is right in front of us, you'll see that the high for the day was made in A period. The market then traded lower for the remainder of the session. We split the session out so you can clearly see what it looks like. Very much it looks like short covering. Short covering forms a B formation, and the A period being like the stem of the B, and then of course, and then the blue area, which is the value area, looking very much, like the B of the B formation. So there was some clues here on the 11th that suggested that the market could go higher. Nothing that suggested it would gap higher the magnitude that it did. But the clues were the attempted direction on the 11th was down. The market did not do a good job of facilitating trade. In other words, it didn't elongate it. It just kind of moved sideways. But most importantly, value was higher. So if the market trying to trade lower all day long and value was higher, clearly the potential there for exploration to the upside was there. But there was nothing that suggested that we would get a gap to the magnitude that we got. And remember, we only measure gaps from the high of the previous session to where the market opens on the following session. We do not measure gaps from the settle. We're only looking for those instances where we're truly out of range relative to the previous trading session. One of the reasons that randomness is so difficult for us to work with is it's unexpected. Now, there were some clues to suggest that we could get a random move to the upside. For some period of time, there's been, a lot of discussion of the trade war with China, a lot of discussions that the market is anticipating gains and that their progress is being made on the trade talks. However, we've heard that before and seen the market go higher. We've heard they weren't going well, and we've seen the market go lower. And so all of a sudden, then we get one more that comes out of nowhere. That is kind of what happens with random events. You can say in hindsight, oh yeah, that was expected. It wasn't expected, not on that day. Additionally, we were going through a period where there was discussion here where we're going to have a second government shutdown. And the first time that we had a government shutdown, the market rallied. So this time the market, when it looked like there wasn't going to be a shutdown, the market wanted to rally. There's just a tremendous amount of randomness in this market. What I want to address first is, how do you psychologically handle randomness? I picked this day deliberately. And the reason is that I should be lecturing myself because I did not handle this day anyway commensurate with my teaching, the trading, and my many lectures on this. I got myself caught a little bit. The previous day saw the market trade lower all day long. I recognized that value was higher, but at the same time, the lower price just weighed on me all day long. I wasn't going to go home short, and I wasn't, looking to be short, but my imagination clearly didn't see the sharp random opening on the 12th. Not when the market closed. Now, by the time the market opened in the morning, we could see what the overnight trade had done, and the overnight trade had clearly taken the market higher. Now, not everybody knew that the market was higher relative to the trade discussions. Some did, some didn't, some guessed, but that's really what caused it. So when the market opens gaps higher, one of the things that we discussed in the introductory course was gaps. The basic rule is to go with all gaps that aren't filled fairly quickly. But more importantly, the larger the gap, the greater the odds that the market will continue in the direction of the gap. In this case, we're talking about an upward gap. When you have a large upward gap, some of the reasons that we can expect upside continuation is that larger gaps are going to trap the shorts. They're going to cause they're going to lead to margin calls. The general wisdom on the street is don't meet a margin call with cash, cover the position. How would you cover a short position? That means you have to buy. So that brings additional buying into the marketplace. When you have a large gap, there's an awful lot of trading based on momentum trading in the market. And the momentum traders have a lot of price-based indicators. When a market gaps higher, it is likely that those price-based indicators will either turn bullish or they'll turn more bullish than they were at the time. If a large gap, such as we're seeing on the 12th, is to be filled, usually the market will begin to sell off immediately from the opening. If the market doesn't sell off immediately from the opening, the odds are relatively low that the gap is going to be filled. Now, on the left-hand side of the overnight inventory, you will see two lows that are very similar. Those two lows mark the lows of a two-day balance. If we can look at the upper extreme of those 2 days, we will see the upper end of that two-day balance. Another one of the rules that we work with is when a market has re-entered any balance area. In this case, it had looked below, it actually gapped below. When it re-enters any balance area, the destination trade becomes the opposite extreme of that balance trading range. Now, that doesn't have to happen. It's just something that we have observed over a period of time happens quite often. You will probably recall from the introductory course that excess and balance are the two most important concepts we deal with. Let's go back and look at the overnight trade from the 11th. When a market gaps higher, we are looking at excess. One of the two most important concepts we deal with. Additionally, when the market opens within the prior 2-day trading range, it entered it from the low and then it's closing, or it's opening well within the range, that opens up a possibility that the market will trade to the opposite extreme of the 2-day balance. On this morning, I had also put out a tweet, and the tweet mentioned that the 200-day simple moving average was within reach. The 200-day simple moving average is up around 27.47. So you can see below it, you see the 2-day balance, and then you see the approximate 200-day moving average. Well within reach. And again, it was something seen ahead of time. You can go back and review the tweets and you will see that it was on Twitter. Okay, we're going to start the session off, and we're going to start with the market playing at about 5 times the speed that we would see the actual market trading. Our goal here isn't to walk you through a particular trading day. Our goal here is to talk about the importance of getting your mind straight when you are experiencing randomness. Okay, now that the market's open, let's stop for a second. When somebody is trading well, they are very quick to take credit to their own ability to be a good trader. When they are not trading well, the easiest thing to do and the most comfortable thing to do is blame the market or blame the randomness of the market. I'm going to tell you that when you are trading well, you will deal with randomness and you will see that randomness is an opportunity. Was it expected? No. But big opportunities come along when you gain the experience to be able to adjust on the fly when these things happen in the market. What will happen to too many of us, we will have and are locked in our mind how much higher price is today than it was at the settled yesterday. Well, then our intuition kicks in, and our intuition tells us, oh boy, that's too much risk. I'm not chasing this market. Or the worst thing would be, I'm going to short this market because this is too high. The market's going to come back down. Those are not the thoughts that you want to have. You may have those thoughts, but you have to overcome those thoughts. You have to take a deep breath and say, okay, I've been taught this. I understand this. I understand that randomness can be used to your advantage in the marketplace. Tied with the randomness, we have a large gap. And we have a rule for handling large gaps. So right now, we have a large gap. And remember what I said earlier, when you have a large gap, if the gap is going to be filled, more than likely, they begin to fill the gap right off the opening. So let's continue to play and see if there's any serious attempt to fill the gap right off the opening. So remember, we're playing, what did we say, 10 times?
This is 5 times.
5 times, okay? So we got a very narrow range. Markets back and forth through the opening a couple of times. Testing a little bit lower. Not much there. If there's nothing on the downside, then the market will explore to the upside. It looks to the downside, it looks to the upside. If it explores to the upside, remember, markets go to very visual levels. The upside visual level would be the overnight high. So you've got a market that is substantially higher in the morning. You're not seeing any immediate selling coming into the market. Instead, what you're seeing is the market attempting to trade higher. Let's stop for a second. For aggressive traders, it's very legitimate here to go long. It's very legitimate to buy calls someplace above the overnight high. I'm not telling you to do that. I'm saying these are legitimate thoughts. Now, it's a long way from filling the gap. So if in fact you buy futures or you buy calls, the trade needs to work fairly quickly. That doesn't mean it's not going higher, but if you're going to do it early, you need to see the market trade higher. You need to see it get above the overnight high, and you need to start to see extension to the upside. Those are personal choices. The most important thing is to recognize the market is traded higher. Gaps are very positive in many cases. The bigger the gap, the greater the odds that we're going to continue higher. Get your head out of the sand and away from the fear that says, oh, price is too high. I talked to a professional tennis pro when I was in the hospital, came by to visit me. And we're talking about trading. And one of the things I asked him, I said, what would happen if you go on the tennis court scared of your opponent? His answer was, you're going to lose. It's the same thing. You've got to get yourself, when you trade, not being afraid of the trade. That doesn't mean you don't respect the trade and you don't respect the risk. But you've got to be willing to take that risk. You've got to be willing to trade without fear. There's a difference between respect and fear. Okay, let's go ahead and play. And the level is going to be the very visual level, which is the overnight high. See the opening? We're well off the opening. Now it gets a little trickier. Once it looks above the overnight high, it's very logical that you're going to get at least some short-term profit taking. It looks above the high, came back in, looking above the high again. If you were long, there's nothing that says to be out of that trade yet. Remember, we have the two-day high, two-day balance area high. That would be the very visual upside reference at this point. All right, the market's been open just 10 minutes at this point. And again, our goal isn't to show you how to trade a day like this. Our goal is strictly to address the idea of randomness and talk about turning randomness into a positive rather than be something that you're going to, list as one of your reasons for losing money. Now, the move was random. Now there's something else to look at. The way the traders trade the market. Is it random today, or will it be fairly consistent? Consistent being with the dispersion model. What do you get? You get innovators, early adopters, early majority, late majority, laggards. So the market, that's certainly a potential that we see early on. Now, it's still early in the day. I think that if you are long the market, you'd prefer the market to stay above the overnight high. It's not the end of the world if it doesn't. I don't think you want it to go back down through the opening. For the range, for the gap being so large, this is a lot of single prints. Now, a lot of times you're going to ask me, what is a lot of single prints? It's one of these questions that I can't give you an exact answer to. It's like we were talking on another video that we're making. If you ask me what time is and do I understand it, I'll say yes. You ask me to explain it, and I'll have a difficult time. You ask me what too many single prints is, do I know? And I will say yes. Can I explain it? I'll have a much more difficult time. It all is relative to the other surrounding factors. And what I'm saying right now, for the market gapping this much higher, this seems to be an awful lot of single prints. Okay, so the gap trading rule is in play this morning. There's really no give back relative to the opening and to the higher gap. So anybody that was waiting for a pullback, and incidentally, one of the mistakes a lot of traders make, particularly short-term traders. Oh, I was going to trade the market. I was waiting for a pullback. You got a market that's fairly strong. You may not get that pullback, or that pullback may come too late. If the elements are there that you should be long the market or short the market, do the trade. Don't try and be an exactness waiting for the pullbacks. All right, so this is still in the first half hour of trade. We got about 3 minutes left till we change time periods. So A period, I say, seems to me to be a lot of single prints. B period will be on us shortly, and then we'll see what happens to B period relative to A period. The most important thing we want to talk about is being able to turn randomness in your favor, not something that is going to work against you. Easy to talk about, extremely difficult to execute. Okay, so B period has taken out the A period high. You can see that it's visually looking at the 2-day balance. It's very visual. It's what markets do. This is why it's so important for you to be prepared ahead of time. Know where the 2-day high is. Know where the 2-day balance, high is, as well as looking at the structure of the 2 days. Know where the 2-day low is. Have a perspective of what's going on. Start early on. Say, what would it take to fill the gap? And remember, if it doesn't fill pretty early, it would be very difficult. Okay, let's go up, and we're at 5 times. Let's go to 10 times. Now, while this is playing out, I want to remind you that we talk a lot about short-term traders. There's the daytime frame traders. Daytime frame traders generally do not take price outside of the previous day's range unless it's to go get some stops or something of that. Normally, when price goes outside of the previous day's range, which would clearly be the case on a gap, it is the result of that trading money that sits above the daytime frame traders. These are huge pools of capital, usually very highly levered, and they can come in at a moment's notice. Now, I'm setting you up for what I think happened on the morning of the 12th. Okay, in A and B period, the market sells off in B period. So we're getting, notice the B period low is a few ticks above half back. Half back is down below it, and half back is very close to the overnight high. Those are short-term references. They're mechanical references. They're the references all short-term traders know. So A period, getting extension in B period. Market's feeling a little heavier. The reason I mentioned that larger pool of capital, they may not chase the market off the opening. They may be looking for some kind of a pullback to buy in size. And any pullback that they would likely enter into would be a pullback that would probably be scary to you and I. Okay, So they haven't really, there's been no real pullbacks giving them any opportunity if they were probably involved in taking the market higher overnight. But new money hasn't had any real chance to come in here this morning. I mean, they could have chased the market straight up. And a lot of people don't like to do that. I think if we bought right on the opening, I don't think that's chasing the market. All right, so you can see B period is now just 2 ticks above half back. C period is coming down. C period matches B period. Rallies a bit. So you have matching lows. Those are weak. See, C period bouncing off the B period low. Very mechanical trading. Not strong when it's coming exactly off of a previous 30-minute low. See them push down there and rally. See that? Hold on just for a second. Feel the short-term traders in here. Buying C period as close as they can to the B period low. As you think it through, do you think that's strong money buying or do you think that's weak money buying? Anybody with size to buy isn't going to be looking to buy at an exact level. The people that buy at exact levels are usually weaker hands, short-term traders. And these are the traders that are also chased out of their positions very quickly. They don't have the staying power. That's something to think about as you're watching a market. Okay, let's continue to play. Let's see, period coming out the B period low. They're still trying to take the market higher. Just feel those weaker traders getting longer and longer. They tried to buy exactly at the B period low. Those are going to be weak hand traders. That doesn't mean they're always going to take it out. It's just something that you want to be aware of. Okay, there's a trap coming up here. I'm telling you this ahead of time. Okay, there it goes. Took out the B period low. We stopped exactly at the overnight high. More than likely, that's not going to last. All right, now, the market traded off. It took out the B period low. It traded back into the overnight range. And what I think happened here, I think there were larger pools of money waiting for a pullback, and I think that's that money that's outside of the day time frame in those big pools of capital. I think that's a serious buy. Now take a look. We have the low. We have a lot of single prints above the low this morning. Notice that I thought there were too many single prints go up to the A period high. Okay, now look back. We've taken back a substantial amount of those. Now, how do you get to the point where you judge there's too many or not too many? Let's stop with the playback. It just takes experience, and you're never perfect on it. But you did see what happened. It did come back, took out a lot of those single prints, and now they came in and they bought it, and the market's trading higher. So where are we going now? Where we're looking, we talked about it a long time ago, 2738, very visual. It's the 2-day trading range high. Okay, let's stop the play for a minute. So now we have a large gap. We have single prints off of the, surrounding the opening. We've seen no serious give back today. We did one quick look into the overnight range. Buying was there. On a day like this, you can expect that stronger money is going to be positioned to buy pullbacks. You now are looking at another mechanical high, which is the 2738, which is the 2-day balance area high. We look below the 2-day balance. We traded back into it overnight. Once you traded back into it, the potential is the 2-day trading range high. And that's where we are right now. Remember, balance and excess, the two most important concepts you deal with. Balance is the 2-day range. Excess is the gap higher opening. And now we have excess in E period. All right, let's continue to play. Let's play it at 15 times. I'm not trying to take you through the trading day. My main purpose here is to really address the concept of randomness and the importance of randomness and dealing with it. Okay, the market's one time framing higher since C period. It's only a couple periods. We're above the 2-day trading range. The next upside objective would be the 200-day simple moving average, right around the 2746 level. And like I say, this isn't something made up later. This is something that I put on the tweet long before the market opened. It's just, this is part of the logic of understanding the market. About the only reference I follow is the 200-day moving average. And the reason I follow the 200-day moving average is almost every time frame, from the shortest of time frames to the longest of money manager time frames, seems to follow the 200-day moving average. And again, if that's what people do, that's what I'm going to look at. I'm going to see what is the response at those levels. So we're above the 2-day balance. The next destination trade would be the 200-day moving average. If you get there, I would suggest there will probably be some stops just above it. They won't be stops to cover shorts, more than likely. They will be stops to enter new positions. So they're buy stops, but they're not buy stops to cover the stops. They are buy stops to enter into a new long position. Okay, so we played this out quite a bit today. Let's speed it up to about 20 times. And while this is playing, go back and ask yourself about the market gapping higher today. Look at where it was on the 11th. Ask yourself, could you have handled that with the price being that much higher? If you couldn't have handled it today, what will you do in the future? Remember, you do your preparation. You do your preparation the night before. You start by looking at the daily, weekly, and monthly bar charts. Then, as we get close to the opening in the morning, and you'll have some idea where the market's going to open because you'll see overnight trade. Then you will update your homework and clearly identify what you're dealing with. Today, you would have identified we had a large gap. You would have identified the gap trading rules. You would have identified the 2-day trading range. And then you would say, okay, the following day looked like the market was relatively short. You didn't anticipate it going this much higher, but there wasn't anything there to suggest that we couldn't, other than a very prominent point of control. But remember, attempted direction on the 11th was down. Value was higher. All right, as the day goes on, as we said earlier, the market goes to very recognizable levels. So the market's continued. I mean, it's like a magnet, isn't it? Sometimes you don't make the trade sometimes because you can't believe that it actually does what we talk about it doing. It just seems to me, oh, they can't be. And a lot of times, just do the trades. Okay, still one time framing since the C period low. What speed are we running at?
20 times speed.
Okay.
Would you like to speed it up?
Sure.
What would you like it? What speed?
Oh, 30. Remember, we're going at 30 times. Okay, now the market traded off. So it's not one time framing. It stopped one time framing in C period. It stopped one time framing in F period. So there's some hesitation in the market. And again, look where it started to sell off from, just below the 200-day simple moving average. Very common. Professional traders, when they get up near those levels, it's not uncommon. The professional traders will take their trades off on this side of a major level. If it gets accepted on the other side, they'll re-enter the trade. So now we've stopped one time framing twice. That may not sound like much, but on a trend day, you generally stop once. This may just be, this may not be important, but it's something to notice. And so much about trading is learning to notice the market, learning to take in the small details. It's very important that you pick up the attention to detail. For example, attention to detail. There was relatively no selling at the opening. The buying in C period, it came back into the overnight range, still left a lot of single prints. At one time, it seemed like there was too many single prints. Okay, now you've got a double distribution day. Double distribution day is a lot on a day that gapped this much higher. Okay, we're getting later in the session. We have an F period high. You can see that market. You know what they're going after. They're going after the 200-day moving average. As we get very late in the session, if H and F period highs are matching, I period moves higher. Okay, you're through the 200-day moving average. That's where the market was going all day. And we talked about that very early in the session. You have to see those things. You have to know where those are. They have to be part of your research, and you have to understand that they are reachable. Okay, now with I period trading up here, if we don't come back down, we would have a triple distribution day. We have a lower distribution, and now with I period trading higher, we have a triple distribution day. The odds are low that we would keep a triple distribution day. What happened? We said if the market got to the 200-day moving average, more than likely there would be what there? We said more than likely there would be stops. So those stops would generally be to enter a new trade, not to cover shorts. So once again, we have a poor high. It's our high for the day. The market's quite strung out. We still have 3 distributions, very unlikely to hold. That'd be an awful lot. So see the market's testing down there. Can it fill in that distribution? First all trades just a single tick above it for quite a while. So it's very mechanical buying there. It's traded, quite a few times. A single tick. It did not close the triple distribution. In order to close the distribution, it's got to trade back into the previous distribution, which is represented by the FH high. Market went up, did not take out the high. Still coming back down towards that J period low. See how just mechanical it's trading? When it's trading so mechanically at that exact level, that's not strong money. That's weak money. When it trades that close and bounces, that's not strong money. Okay, now, it's not a lot, but they have closed the distribution. So we now have a double distribution day. We have a poor high. The odds are that high is taken out today or overnight. One of the mistakes you make is, oh boy, this market's really high. This market's dangerous, and you go short. You may make some money on a short, but it's a bad trade because the odds are that this auction's not over yet. And it's not over because there's no excess on the high. Okay, so the market for the third time has stopped one time framing higher. we're getting some sell-off late in the session, but the market traded higher all day long. We reached all the goals that we had in mind. Okay, let's stop at this point. Our goal wasn't to take you through how to trade a day like this. Some of that came up. For example, you go with the gap. But the single nuance we wanted to drive home was the importance of understanding randomness. Randomness can be a real destructive element to you, or randomness can be a very positive element. When you get to the point where you can use randomness to your advantage, you are clearly making substantial progress in trading. It is real. It happens all the time. And there's just a lot of things going on around the world. It used to be that the markets in the US traded fairly heavily on what happened in the US. Now today, we close in the US, the market opens, in the East, then the market trades and closes. We open in London, we come all the way back down, and we start trading in the US. The world is very tightly woven together now versus when I started many years ago. And all of those different areas where the market trades can have a strong influence on the market. So I'm going to say stop it here. I want you to take this focus on randomness. Have yourself prepared for when you have to deal with random. You don't freeze, you don't fade the randomness, and you're not, oh my God, I can't do anything. Randomness can work for you as long as you understand it and you understand that change occurs all the time. Thank you.